Okay, auditing. This is lecture number 4 on chapter 10. I'm on page 524. We'll look at exhibit 10.11 in just a second, but up at the top, if you see, you'll see that this talks about kiting with interbank transfers. So I'm on preparing an interbank transfer schedule. So as a company with many divisions frequently transfers cash from one division to another, the auditor should be alert to the fact that companies wanting to overstate cash may use a technique called kiting to record the same cash twice. Kiting is done by making transfers near year end from one bank account to another bank account, recording the deposit in the second division's account, but not recording the disbursement in the first division's account until the next fiscal period. So effectively, I'm saying, okay, I'm going to move money from one to the other, but I'm only going to, for the current year, this is why the cutoff is so important, the current year, I'm going to record the deposit for the one company, the one that's increasing, but I'm not going to record the withdrawal from the other bank account for the other division. So what we do, an effective way to help with this is to create an interbank transfer schedule. So this is examples of within one company with two different divisions, something that happens. So Division A transfers $1 million to Division B near the end of the year. Division B receives it before year end, but the Division A is recording it after year end. So the transfer does not clear the bank. The transfer does not decrease the year-end balance because it had not been recorded in the current year. Deposit may or may not be deposited by year-end. If not, the deposit will be shown as a deposit in transit and in the bank reconciliation. Transfer increases the year-end cash balance by the amount of the transfer. The net effect is to overstate cash for the consolidated financial statements by the $1 million, effectively in this case. Effectively, we're counting the $1 million twice. The way they're doing this is they're saying there's $1 million in both Division A and Division B. That's just not the case. And since it's an asset, and since this is a company that's all one company, really all that matters is I'm just not counting it twice. It doesn't really matter in the end if I'm doing consolidated financial statements, whether it's in Division A or Division B necessarily. I mean, although gap-wise, we want to make sure it's in the right place. But all that matters is I'm not counting it in both Division A and Division B. Okay, this is what a bank transfer schedule looks like. This is on page 525 of your chapter. So it kind of tells you about the fact that, it also has some of the footnoting, by the way, that you want to take note of, has the check numbers and transfers and things like that. This is a transfer schedule just to kind of trace and make sure that everything is where it should be in this case. Also notice I didn't have this in the other one, this AJEC 11. That means there's an adjusting journal entry because a withdrawal was recorded in the wrong place. So we've proposed an adjusting journal entry to not double count cash when you find something like this. Okay, on page 526 now. Performing substantive, wait a minute, 526, no, I'm sorry, 524, pardon me. Performing substantive fraud-related procedures in cash accounts. So things that we do, we just looked at confirmations. We confirmed with financial institutions, the individuals that are authorized to access cash accounts. We scrutinize checks that are payable to cash and scrutinize checks with unusual vendor names. So we're looking for things out of the ordinary, and then just cash checks. We really don't have a lot of checks that should be written for cash. That's kind of an abnormal thing. Documentation. So how we document this, we look at the bank reconciliations, bank confirmations you looked at, documentation of the oral confirmations if applicable, meaning if I called someone. So this is a good example of if you don't have a paper trail like a confirmation, you want to at least make note of it, date it, time it, everything you can do to make sure that there is some sort of trail for it. Copies of the bank cutoff statement, copies of the bank transfer schedules, and evidence of any restricted cash or restricted on the use of cash balances or compensating balances. Okay, auditing marketable securities. This should hopefully ring a bell from Intermediate 2 if you've looked at marketable securities in there already. A little bit about what we need to do and how we need to make sure that things are held where they're supposed to be held gap-wise. So we're going to talk about what the significant accounts are. First of all, just to be clear, marketable security is either a debt or equity security that's held as a temporary investment. It also could be short-term cash investments, UST bills, deposits, CDs, commercial paper, unsecured short-term promissory notes. All are things that are marketable securities. So our securities are classified as either held to maturity trading securities or available for sale securities, available for sale. And we record those against intermediate questions, but we record those differently depending on which one. And as usual, we want to look at the disclosures for them. We actually have a specific disclosure for this to show our breakdown between what the different classifications of investment securities are. And then again, our relevant assertions, existence and occurrence. We want to make sure those securities actually exist at the balance sheet date. So if a company that you own stock in is no longer actually a company anymore at the balance sheet date, then that shouldn't be something that's on my balance sheet. Completeness, making sure that any marketable securities that are owned are owned during the period are in the proper period. Rights and obligations, that we do have title to those marketable securities. Make sure we have legal ownership. It's not something that passed after the balance sheet date or anything like that. Valuation allocation. I'm on page 527, by the way. Recorded balances reflect true underlying economic value of those assets. And presentation and disclosure, making sure they're properly classified on the balance sheet, and disclosure notes to the financial statements. Okay, an overview of our audit opinion. This is on page 528. The auditor will look at risk assessment procedures. If there's any risk of theft or any risk of sudden market declines. We're also going to test controls, and we're also going to look at substantive procedures like we have on the rest of these. So inherent fraud risk of marketable securities, risk of sudden market declines. If you're invested in the stock market, it depends on what the security is, but it also depends on the volatility of the market at the time and what area it's in, those kinds of things. But there's always a risk of the market declining. We're in a major decline right now because of COVID-19. Not that people wouldn't necessarily seen that coming, but certainly right now we're in a more volatile market than what you've seen in the past. Manipulation of the classification of securities, okay, putting something in a held to maturity rather than available for sale or vice versa, either way. And manipulation of the valuation of the fair market value. Usually tougher to do if it's publicly traded because fair market value is relatively easy to find. This is more likely to happen on something that is more vague on its valuation and how we would value the stock. Control risks, I'm on page 528, by the way, related to marketable securities. Risk of theft of securities, lack of policies over purchasing and sale of securities, lack of monitoring of changes of security balances, lack of policies over valuation and classification, lack of segregation of duties, again, just like cash, the investment decisions versus who has the custody of them, and then lack of overall oversight by the internal auditors. So this is an inherent risk analysis questionnaire. And these are just some questions we'd ask those in charge of the marketable securities, how management takes care of those. And this is really just to kind of gauge the inherent risk. So the risk of market decline, the risk of manipulation of securities, and the risk of market value is really what this is for. This is a questionnaire to look at those control risks we just went through. So I'm not going to read these to you. You can pause the video and read them, or you can look at the PowerPoint slide yourself. But this is effectively to get down to those control risks we just talked about. Policies, monitoring, segregation of duties, all those things should be flushed out if you're asking these questions of the right individuals in the organization. And by the way, just because they have an answer for it, there's still, with control risks especially, there still are obligations to confirm that the policy is being utilized. We do things like reperformance and everything else too. All right, performing analytical procedures for marketable securities. This is page 531. Like most things, we're going to develop expectations about the level and the amounts and the ending balances of the marketable securities, the accounts based on purchase or sales activity by management during the year. Develop expectations about the relationship between balances of marketable securities accounts, rates anticipated to be earned, and interest and dividend revenues. So Not that anybody has a year end right now. Well, they could. I guess they could have a year end. So let's say someone had a March 31st, or maybe if it still didn't come back, an April 30th year end. We would not expect their marketable securities to be doing well with how the stock market is done. So my expectation, if I was developing an expectation, I'd look at what the market's doing overall. Let's say they deal in publicly traded securities. I'd look at how the market's doing overall, and my expectation would be that they're way down, substantially down. You know, I'd look at the Dow Jones Industrial Average or the S&P 500, look at the average percentage that's been down for the last, 6 weeks or so, and then develop an estimate on what I think theirs should be, and then compare what theirs is versus what I think it's going to be. This was something you should have done in your data analytics problem that you just worked on too, because you have to have a guess going in from an external source. It's kind of the best way to develop these. So we review changes in balances, risk composition, classification, types of marketable securities, and related stage investment policies and plans as well. Okay. When we have a risk, if we have identified a risk of material misstatement, we determine the performance of the procedures. This is on the bottom of 531. Remember, we always make our procedures proportional to the assessed risk. That bullet point is going to be underneath every single one of these. Once I have identified a risk, I adjust my procedures based on that, either making additional procedures or lessening my procedures based on the risk that I have seen. So it typically involves substantive procedures and tests of controls if it's applicable. Okay. Common tests of controls for marketable, common tests for controls of marketable securities. I'm on page 532. I'm not going to read them all, but reviewing policies for authorization to purchase, sell, and managing marketable securities, inquire the board of directors as to what their oversight role is, examining evidence for authorization control changes, examine documentation for selected marketable security transactions. They're all things I would do to look through and just confirm. More than anything else, I'm looking to make sure that people aren't buying and selling without authorization, that there's some sort of policy and procedure as far as who can, who can't, is there a dollar amount limitation, what kind of controls are involved. And then we need to also, as always, consider what comes out of these tests. And do I believe that they have controls? Do I believe that they're working properly? Do I believe that they're monitoring them properly? All those elements, and that's all on page 532. Okay, obtaining substantive evidence about marketable securities. This is bottom of 532 and over on to 533. The planning analytical procedures discussed, we already talked about, but you'd also want to do appropriate substantive analytical procedures if conducted using the appropriate level of precision. However, it's likely that the auditor will focus more of the audit effort on substantive test of details. Okay, so I like these, as always, I like these exhibits here because this is kind of an abbreviation of all the different assertions and substantive tests for details. So these are all things that you would want to do to confirm the given assertions, the 5 assertions within marketable securities. And again, I'll let you read those. I do think you should read those, but I'm not going to read them to you on here. Here's another good example of a work paper. This is on page 534. Again, make sure and notice the tick marks. Notice that a lot of them have stayed the same. F is pretty much always for footing. TB is pretty much always for trial balance. And then obviously anything else we've got down there on the bottom, if we've recomputed things or if we've checked in a specific place, like the Wall Street Journal, it says a stock transaction for Wall Street Journal, for one of them we checked. And then also notice the date and preparation up above. And dating is always important. So when we start with assets, especially something where there's buying and selling and trading involved, we have a beginning balance from prior year. And then we have what has happened in the current year. And we have an ending balance. And then we have, what accounts are involved, like interest, dividends, those types of things. If we're buying and selling, could have gain or losses on disposal. So I would spend some time, I'm gonna go back, I would spend some time looking at this closer than what I just did. Because again, I think these examples of work papers are really important, and I'm afraid we're not gonna get as many examples of them together as I would have hoped. So please do take time to look at that some more. Okay, documentation that the auditor uses is going to have our schedule. That's kind of what we just showed there. Any confirmation if I confirm securities with the brokers. marketable security transactions that were scrutinized, memo containing rationalization for judgment made about management's valuation of securities, and if I need outside valuation, where do I get that from? Okay. Okay, auditing complex financial instruments. This is on page 536. So the big thing I want to make a point here is when things get complicated, if something is something that is too hard to understand, it's always a good idea to call in an expert, or even if someone else on your team understands it better, because the fact of the matter is, in this day and age, the complexity of financial instruments has gotten to the point where unless you use it on a regular basis, there are definitely some, there's quite a few that I know that I've never utilized. And probably if I was going to go audit it, I would either need to study, I need to talk to somebody about it, or I need to bring in a separate individual or someone on my team that knows more about these financial instruments. The good news is when you audit companies year to year, back to back, then you can do better with this and not have as much trouble because you've seen it before. But you have, always have the potential for auditing something clean and it not being if you don't fully understand the financial instrument. These are some examples of financial instruments, more complex ones. Some are not as bad. Put options, call options, not too bad. Floating rate notes. But you get to like foreign currency hedges and securities sold with a put options, collateralized mortgage obligation, and that one's not too bad either. Commodity hedges, fuel hedge, all the hedges can be tough. At least for me, they were. So 537 has a good kind of list of different types of complex financial instruments that you can look through. And that's about it. We have Exhibit 1019 that you can look through for the control risk related to these financial instruments. The big thing is that a lot of times management doesn't even really understand what's going on here, and that can be a problem because that is a good way for an accountant to, do things they shouldn't be doing with financial instruments just because they know they're the only ones who understand it. So that's a major element of risk here too. So there's some inherent risk there with complex financial instruments that I think should be mentioned. So that is the last lecture for chapter 10.